Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Steve Penny from the Silver Chartist. And our affiliate link with him is silverchartistliberty.com. Find the link in the description of this video. Steve, thank you so much for joining us today.
You bet, Elijah. Thanks for inviting me back. I'm looking forward to a good conversation.
Well, it's great to have you. And I've been wanting to have you on because, we've seen this dramatic rise in the metals. It is kind of, we're coming to the end of the year, and looking back at the charts is kind of funny because you look at gold, it made a huge run up and made a huge run down, and now we're pretty much where we were at the beginning of the year. So first, your take on the recent rally we've seen in the last month or two, and then kind of this year in review.
Yeah, you're right. Silver and gold look like they're both going to end the year pretty close to where they started, but with a lot of volatility in between. And that kind of shows when you look back this past year how volatility can be your friend if you are a contrarian. If you use those gut-wrenching pullbacks to scale in and accumulate, and if you're more short-term oriented, you could use those kind of rips to take a little bit of profit. So volatility can be used to our advantage, but I think we're setting up here for a very interesting and exciting 2023, especially for precious metals investors.
And if you did want to kind of share with us the charts of both gold and silver, maybe starting with silver here, and your outlook for 2023, coming this year.
Yeah, for sure. So I'll go ahead and pull up a chart of silver here. And, if you're like me and your listeners are like me, I'm getting sick and tired of talking about the Fed. They get way much more, airtime than they should. But unfortunately, that's going to be the primary driver of most markets, including the precious metals, as we head into this year. And, there's this kind of debate. Is the Fed going to pull a 180, or are they going to stick to their guns and raise hikes into a slowing economy? And we could talk about that as well, because it kind of is relevant to this chart. But when you just look at the chart, this goes back to March of 2020. So there's the COVID low. And you can see this rise that you were just talking about. We bottomed here at $17.40 and made a high last week of $24.50. So that's a really nice run here in the last couple of months in silver. And we are getting overbought. We're due for probably a short-term pullback, but all indications do suggest that the trend has changed. We've seen higher highs, higher lows, and we're back above the key moving averages. We're back above the 200-day moving average. We're back above the 50-day moving average. And when I zero in on a daily chart here for silver, you can see this 50-day moving average has just bullishly crossed above the 200-day. That's a bullish technical signal. All of these things tend to put those algorithms that really drive these markets, especially the paper markets, into a buy the dip mode as opposed to a sell the rally mode, like we saw, in much of 2022. That said, you can see we're getting a little bit overbought here and probably due for a pullback. I would love to see a pullback towards this 200-day moving average. That would be just a fantastic buying opportunity from my perspective. That's all the way down at $21.29 right now. Not sure we'll get back that far, but to be honest, I'm kind of hoping for it, just to kind of wash out some of this short-term speculative fervor and euphoria that we've seen just in the last few weeks.
And as for gold, are you seeing a similar situation in there where it's overbought?
Yeah, but not quite as much. If you look at the gold-silver ratio, I'm not going to pull it up here just for simplicity. I can if you'd like me to. But silver's really outperformed gold by a wide margin just in the past month or two. That gold-silver ratio got all the way to 96-1 just a few months ago, and now it's compressed down into the 70s. So silver has outperformed gold by a wide margin in a short period of time. I think silver is still way undervalued relative to gold, but on a very short-term basis, it's moved really far, really fast. So I think silver is a little bit more overbought relative to gold. You can see gold is sitting here hovering right along its 200-day moving average. That's a nice consolidation pattern right along support. That 50-day hasn't crossed above the 200 yet. But just like silver, it does look like the trend has changed. We see higher highs back above the 200-day moving average, and things look constructive. The COT reports for both silver and gold are still in bullish territory as well.
Now, you mentioned what the Fed might be doing in the coming year. It seems like, we've seen quite a lot of rate hikes this year and dramatic rate hikes. So what is your outlook for what the Fed could do? Maybe a couple scenarios that you've thought through and how it could impact the markets.
Sure. What's happened here in 2022 really is unprecedented with the pace of change of, this rate hike cycle. We started in, I think, March of 2022 with the first 25 basis point hike. And, they've hiked at every meeting since. So there's a lot of like debate, especially in the precious metals community. Are they going to continue to tighten into a weakening economy, or are they going to pivot or pull a 180 and go back to debt monetization and lowering interest rates as the economy begins to weaken? And the way I see it is there's three potential outcomes. And, I think it's very important that we define our terms too. The word pivot gets kind of thrown around a lot. To me, a pivot means like a slight change in direction on the way towards a complete 180. So I think the pivot has already happened. We've gone from 75 basis rate hike back to now 50, and then it's expected to be 25 in February, probably 25 in March, until we eventually pause around 5%. So I think the pivot, the easing has started to happen, even though we haven't pulled the 180 yet. So the three scenarios I see is one, like what Powell's plan is. You could even call it Powell's plan, where he just kind of slowly gets the interest rate up to around 5 to 5.25% by May of 2023, and they call that the terminal rate. And his goal is to get interest rates up to that around 5%, and then pause, and then inflation naturally comes down on its own from there. And that might sound good on paper, but I think it's very unlikely that they can pull that off without breaking something. The other alternative is kind of like the soft landing narrative that gets tossed around on social media or on mainstream media, I meant to say, where, they kind of slow their rate hikes campaign, eventually pause, and we come in for like, maybe a mild recession, lasts, a few weeks or a few months. And then we kind of, go on to life as normal. That's kind of I think the more generally accepted narrative. But I think the most likely outcome is the third scenario here, where they break something in this process. I think Powell has referenced Paul Volcker several times now, and it's obvious that he's studied, Volcker's mistakes and the way he, beat inflation back in 1981. Well, a lot of us in the precious metals community kind of look back at Volcker as the one who crushed inflation, but it's easy to forget that he took office in 1979, and there was a severe recession right into his first, right as he took that seat, and he cut interest rates by like 7%, and that's when inflation spun out of control, and then he had to raise interest rates even more aggressively. And I think Powell does not want to make that same mistake. So I think he's probably going to stick to his guns here and keep raising rates. But unfortunately, I think something's probably going to break. We could see some kind of liquidity crisis or something like that. It seems very likely in the coming months.
I know it's been said that when I know we've had guests on in the past, and they've made the point that the Fed cannot control inflation by raising interest rates below the level of inflation. So even if the Fed, gets interest rates to like 5%, we're still seeing inflation above that. So it really does seem like the Fed doesn't have any option, because they can't get interest rates above that inflation rate.
Yeah, and it comes down to a little bit of semantics, like how do you measure inflation? Real inflation, the way you and I would look at it, the way John Williams measures it using generally accepted accounting principles. Yeah, inflation's still probably north of 10%, well over 10%. So they can't get the interest rate over 10% without just absolutely devastating the economy. So it depends how you measure it. And the Fed's favorite tool is core PCE. And right now, last I checked, that's around, I want to say 5.1, 5.2%. So it is possible they get nominal rates above that core PCE, and then they can say, hey, we've got positive real interest rates, even though in the real world, that's not reality. But, it's possible they do get the nominal rate above that core PCE, and then they say, hey, look, we've got positive real rates here.
Yeah, and forgive me if I'm incorrect about this, but I understand that core PCE is essentially taking away everything that people need to actually live. Food and fuel, right?
Yeah. It's like everything they do, it's deceptive and it's not right. But they lie with statistics, they lie with numbers. Almost everything they say is not, grounded in reality. So you're exactly right. It excludes, housing prices. It excludes fuel. They use owner's equivalent rent, all kinds of hedonics and, manipulation of statistics. Yeah.
and I guess mentioning maybe those manipulation of statistics, we'll see if it applies here. But if we look back at what they've done in 2022, on the surface, it seems like, oh, maybe they have kind of accomplished the soft landing. We only see the stock market, depending on which index you're looking at, 10 to 30% down, and we've got interest rates above 4% for the Fed funds rate. So that's, and we're slightly coming down on inflation. So it seems like they are kind of maneuvering and getting us this soft landing if you look at kind of the mainstream numbers there. But your perspective on that?
Yeah, it's Jim Sinclair used to call it MOPE, or Management of Perspective Economics. I know you've had Bill Holter on your program too, who works with him, and he's used that same acronym MOPE. But anyway, the idea is, if you can convince the public that of the narrative, the idea is that reality won't matter as much. Unfortunately, reality always matters at some point. But yeah, can they convince the public that they've maneuvered a soft landing here? To me, very unlikely. I mean, reality is going to set in, and probably in the early part of 2023 is what I'm expecting.
Now, when it comes to, I guess, the precious metal markets, in light of what the Fed may do, you're saying they've really already pivoted because they've changed direction, right? They're going to lower, they're decreasing the rate of increase right now. Right. So as we look into 2023, how do you see the metals markets being impacted by the Fed's decisions?
Yeah, it's I'll be honest. So ideal and probabilities, not predictions, right? And I can see a variety of potential outcomes, all of them resulting in metals being higher by the end of the year. It's just the path that we take to get there. So my baseline scenario is that the markets are forward-looking and they're going to anticipate this pause. And I see a rally into that pause. But I don't think they pull a 180, what some people will call a pivot, where they go back to debt monetization, lowering interest rates until something breaks. I think that's what's going to be the catalyst for them to go back into debt monetization. And that's when we see the really big, sharp moves in silver and gold. And I think that's probably going to happen in 2023. It's hard for me to foresee a scenario where it doesn't actually. So I think the metals move higher, anticipating the pause. Something probably breaks. They may react, negatively, like a lot of asset classes in a short-term liquidity event. But I think those monetary spigots get turned on faster than anything we've ever seen before. And that's when the metals go ballistic to the upside.
Now, this year, not only in the metals prices have been very volatile, but we're also seeing in the physical market just extremes that really we haven't seen before. I guess maybe, back in when COVID first started, and then also during Silver Squeeze, but we've just seen huge premiums, an increase in premiums and shortages in supplies. A few months ago, we were seeing one of the major wholesalers in the US essentially almost completely out of physical product. Now physical supply is coming back in a bit, so premiums are dropping as the spot price has gone up. But we've just seen this extreme volatility of, a lot of bullion dealers, including Miles Franklin, saying, are we going to be able to source product in the future? Do you anticipate that, I guess, volatility in the physical availability and premiums continuing in 2023?
Yeah, I do. I'm not an expert in, you know more about this than I do, the short-term retail demand and how premiums are affected and everything. But yeah, that was historic premiums that we saw earlier this year, and they're still high. And I do think there's going to come a point, not necessarily in 2023, but it's possible, but in the coming handful of years, where people will want to get their hand on physical metal, silver and gold, and they won't be able to. And I think of like Venezuela right now. How many of those poor people would love to trade some fiat currency that's just being debased at a massive scale for some physical metal? They can't. It's not an option for them. So the idea is to use volatility to your advantage, dollar cost average, maybe increase your dollar cost averaging when, there's these sharp pullbacks, because I believe there's going to come a time where you can't get it. And it kind of highlights, over on our website, some of our members were asking, if you're seeing a short-term pullback here in the metals, why not sell some or sell all of it and then buy back cheaper? And the risk with that is, if you get too cute, that it just runs away without you. So, and eventually the physical market is going to be where price is set, and the COMEX is going to become less relevant or irrelevant. So, there's coming a day where the price is set by demand, supply and demand fundamentals of the physical market, not these paper contracts that can be issued at will by, the COMEX.
Yeah, I mean, the funny thing that I've noticed as we're, selling bullion is as the premium is coming down, the spot price is going up, and I'm looking at the prices that clients we're charging clients for the products, and it's like, and often what we have to pay for the products as well. A lot of this, the raise in premiums and the decrease in premiums are coming from the wholesalers as well. But it's interesting because what's happening is, maybe you're paying $28, $29 for a silver coin. But 2 months ago, when the spot price was way lower, people were paying that much
Right.
and for the silver product as well. And for silver eagles, you're still having to pay $35, $36 today. When silver was 18, that's how much you were having to pay. So it's like, it's so funny where it's like, if you try to time the market, a lot of the time, because of this volatility in premiums, it's not actually going to work. It's the question is going to come down to, in a lot of circumstances, can you actually get the physical product and for what price? Because the physical market is completely different, it seems like, at least in recent history.
Yeah, I think anything like sub $21 silver, $22 silver, any further price decline in the paper price, if you're looking to accumulate physical, is probably just going to be offset by an equal rise in the premium. So the bottom line, it's really hard to get physical silver for less than like $22. I mean, even if the spot price falls to, back to where it was in the 17s.
And one of the questions here is also on the physical side. We're looking at a lot of physical silver being drained from the major exchanges. We have a viewer wanting to know your perspective on that. Do you think the COMEX or LBMA won't be able to deliver due to availability? Your perspective on that?
Yeah, how I look at that, I've been in this market for about 15 years. I know you've been in this following the precious metals market for years as well. And this has kind of been a continuing theme for probably 10 plus years. The COMEX is going to default, or the LBMA is going to default. And I believe that is going to happen, but trying to predict the timing has been, many people have predicted that. Probably there's been hundreds of predictions from very smart people that the COMEX is going to default. I think it's probably going to happen, but I don't make short-term investment decisions around that. To me, it's just something that's like a potential upside kicker. Of all the reasons to invest in silver, the main ones are debasement of currency. And then you've got these upside kickers where if the COMEX defaults, I mean, that would just be a tremendous upside kicker. But I don't, I watch it. It's interesting. Open interest even in the futures market right now is I think 10-year lows in silver, and gold is way down there too. So these are interesting developments, but I don't make short-term investment decisions around them.
No, I did want to get your perspective also on the general market in 2022. This year, we have seen a lot of volatility up and down in the stock market. A lot of people were thinking that the stock market was going to crash. That may still happen. It seems like we may just kind of be in a phase where there is kind of a dead cat bounce right now. But we are seeing in some of the indices, a higher high being made. So I wanted to get your perspective on the stock market and what you see for it in 2023.
Sure. So for this one, it might be beneficial to go ahead and share my screen if that's all right with you, Elijah.
That's perfect.
I'm going to go ahead and pull up a weekly chart of the S&P 500, and I'll share my screen here in just a moment. So you can see this very clear red downtrend line goes back to the highs of the stock market peaked in January of this current year, January 2022. And we've just made a series of lower highs going all the way back all year long. I call this, I look to take short positions every time we test this line. I shorted here, shorted here, shorted here. Didn't short on this one, and I'm kicking myself for it because we got 3 red candles. But this red line coincides with the 200-day moving average. So I'm going to go to a daily chart right here. And you can see how closely this red line coincides with that yellow 200-day. And we've talked about before how algorithms tend to be in a sell the rally mode below a declining 200-day moving average. And that's also the simplest definition of a downtrend. So stocks will remain in a downtrend. And, the trend is down until it isn't. If we break convincingly back above that 200-day, you could start saying, hey, maybe stocks are going to rally. As far as here's my outlook for general equities. Baseline roadmap. I think when the Fed pauses and eventually does a 180, general equities will most likely see a really nice pop as well. Whether they go make new all-time highs, I don't know. But there's always the risk. And I think this day is coming too. One of these times, the Fed is going to print money. They're going to turn on the monetary spigots. And eventually, it's not going to work. They're not going to get the desired outcome. Maybe interest rates are kind of running away to the upside and they want to bring interest rates down and they want to kind of goose the stock market a little bit. And so they, print money, do more debt monetization, and they don't get the desired result. So that's why I kind of steer clear of general equities for right now. And, that's why, hard assets present the most favorable risk reward ratio over the next handful of years. I think the rest of this decade, really.
I can't remember the exact term, if it's a silent crash the stock market has gone through before, where it's like you have inflation, but the stock market just goes sideways. And it seems like that's definitely a situation we could have if the Fed, goes back to easy monetary policy, and then the stock market just doesn't react to that. It's going down in real value at that time.
Exactly. Was it last year or the year before, Venezuela had the best performing stock market in the world. But of course, that's in nominal terms. It didn't preserve purchasing power the way, hard assets did, especially silver and gold. But you could see a scenario where stocks double, but everything else quadruples. Well, did stocks double, or did they go down by half? And I would argue they went down by half relative to everything else, even though the nominal value might go up. So that's where ratio charts are so powerful, because they remove the dollar from the equation, and you're just measuring one thing against another thing. And you can really find where the value is. And on that note, Elijah, if it's all right with you, I'd love to show this silver to Dow ratio chart, which, because if I didn't show the chart, it would almost sound like I'm just like it's a internet hype, kind of trying to get clicks or whatever, because it's almost unbelievable. But this is just data. This has happened over and over in history. And like I said, it would sound sensational if I didn't have a chart to show you. If we were to go back to where we were in 1980, silver would outperform the Dow by a factor of 50. Like I said, it might sound sensational, but that's just data. That's happened before. Could it happen again? I think it's very likely to be honest with you, over the next handful of years, not necessarily in 2023, but I think we'll get back to this ratio at some point this decade. And that shows where the value is. And it's interesting too, the pattern that this ratio chart is forming. I drew these lines a couple of years ago, or at least a year ago. I drew them a long time ago. And it's interesting to see how well prices respected these lines. And once we get a breakout above this downtrend line that goes back to 2011, so this is like a 10-year downtrend line, that's where I would really look for silver to begin outperforming general equities. And once the metals begin outperforming stocks, that's when you're going to get a lot of the attention of those generalist investors. When institutional money starts piling in, those aren't necessarily the people who are looking for hyperinflation and all these kind of things that your audience is familiar with. They're just looking for relative outperformance. And when they see the metals outperforming stocks, that's going to be, I think it's really going to catch their attention and be a tailwind for us.
Before we let you go, Steve, if you could kind of share with our viewers again, kind of the price points you're looking for in both gold and silver. If you could share those charts. I know we have a lot more viewers who have joined since we looked at those at the top of the interview. So if you wouldn't mind just sharing that again for our viewers.
Absolutely. Yeah. I'll just go to a daily chart for silver here. Yeah. 2453 was the high from a few days ago. I think we're probably getting a little bit stretched here. So due for a pullback. That would be healthy to work off some of the speculative froth that's come in over the last few weeks. Initial support is at the lower rail of this sharp uptrend channel here. Wouldn't be surprised if this gave way and we pulled back towards the 50-day and the 200-day. That's currently down around 2150. Not sure we get back quite that far, but I'm hoping for it, because that would be a really nice buying opportunity. It would work off this RSI. It would turn the COT back to being extremely bullish again. That the momentum chasing speculators would be washed out. So looking for a pullback, hopefully towards just below 22, let's call it between 21 and 22 in silver. For gold, it's not as overbought as silver. It's sitting right at its 200-day moving average. Optimistic that this support right here at about 1790 to 1800 will hold. If it doesn't, you've got this 50-day moving average that's moving up quickly down around 1740. So call it 1740 to 1750 initial support on gold. And I think any pullbacks to those areas will be really good buying opportunities for both short-term traders and longer-term investors.
All right. Well, it looks still like a wild year ahead in 2023. Thank you, Stephen, for joining us today. If people are interested in continuing to track this with you, they can follow our affiliate link in the description of this video. It's also, you can just type in silverchartistliberty.com And again, I keep mentioning this every time we have you on, but one of the things I really like about your service is it's a complete over the shoulder look at your portfolio there in natural resources and precious metals. Not a lot of people actually do that, where they just completely share what their whole portfolio is. So if you can share with that, kind of tell us your service for our viewers.
Yeah, it's a fully transparent over-the-shoulder service with real-time alerts. Anytime I buy or sell in my long-term account, I send out an alert to the members. And yeah, it is kind of a rare thing. I share exactly what I own. So you see it all, and you see the red, and you see my mistakes too. I don't cover them. It's not a model portfolio. It's literally exactly what I own. I take screenshots from my brokerage account, share them with the members. And when I buy and sell, I send out alerts. We've also got an awesome team of contributors. We've got David Brady. I think he's probably the best short-term, or let's call it precious metals forecaster out there. I mean, he really has a knack for identifying turning points in the precious metals market. Grateful to have him. Jeff Clark, one of the best mining stock analysts out there. Grateful to have him on our team. We got a new contributor, Kyle Heineman. So really cool community we're building, and invite anyone to come check it out.
All right, Steve, once again, thank you so much for your time, and God bless.
Thank you so much.